You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. We're with you every Saturday, 9 to 10 a.m. and again to 3 to 4 p.m. here on News Talk 98.7 WOKI. Would you rather have an extra $1 million in retirement savings or 5 more healthy years at the end of your lifespan? Healthy years being the key. That was a question posed in a recent study, a recent survey from Edelman Financial Engines. Just over half of Americans, 51%, said they'd rather add $1 million to their nest egg than live 5 extra healthy years. The latest edition of the firm's 2024 Everyday Wealth in America study highlights a growing focus on financial concerns of retirees and Americans at large. Another 58% agreed they need at least $100,000 in annual income to live financially worry-free, and 25% believe they'll need more than $200,000 of annual income. And so, according to one of the people that did the study, he said that we're noticing once again that Americans, even the affluent, are not feeling overly confident about the state of their finances. And part of these worries stem from external pressures, inflation, turbulent election environment, and some are individual pressures, family responsibilities, mounting credit card debt. Now, a couple of other things that are interesting from the study, and then we'll talk about what this really means. You know, what can we learn from this study? But it revealed that 37% of those responding indicated they want a more active and adventurous retirement compared to previous generations. But 2/3 felt somewhat confident about retiring comfortably, but nearly 1/3 feared they might never be able to retire. So, a lot of interesting things to take away from this. I posed this question to Dee Dee, my wife, this morning. Would you rather have $1 million extra in retirement savings or 5 more healthy years at the end of your life? And she was like, oh my gosh, that's a tough question. And she opted for 5 more healthy years. I think that's what I would do as well. However, it was a coin flip in this survey. So, you know, what is my stance on this? Why do so many more people feel like they want quality of life and they want the wealth to be able to be more adventurous, yet they would pass up 5 more healthy years? And I think it's a perception that things are difficult. One of the things I talked about recently on Phil Williams' show, I was on this earlier this week, is that pre-retirees, people who are not already retired, have a significant concern about being able to afford retirement and have stability of retirement income, whereas people that are already retired and living that retirement feel more confident that they're going to be okay. So pre-retirees have a lot more worries of being able to afford retirement than people who are already retired. And I think that's an important lesson, because I think people that are retired, they see the impact of, one of the big things, people talk to me all the time about what their tax bill will be in retirement. And, you know, you look at your current paycheck, and you have a lot of stuff coming out of your paycheck that you're not going to have coming out when you're retired. You are going to need to take your life savings and generate a paycheck without working. And, another thing I said on Phil's show is we don't retire on assets, we retire on income. So we've got to be able to take those assets and produce stability of income. But if you look at your gross pay and your net take-home pay, it is a very, very stark difference, right? But it's not just income tax that's coming out of your paycheck. One of the most significant things that goes away with retirement income is the payroll tax. 7.65% of your paycheck goes to pay payroll tax. Now, most of that, 6.2% of that, is for Social Security. Now, your employer is also paying 7.65%. Now, that's up to about, I don't have the number in front of me, up to about the first $160,000 of income. And then when you get over that, the Social Security stuff goes away. So instead of 7.65%, you drop down to 1.45%. But, that's a big chunk of money that you're not going to be taxed in retirement. And your regular paycheck, you get in ordinary income tax, but you get the payroll tax too. Then of course you're probably maxing out or putting significant contributions to your 401k. Now you've got health contributions, health deductions, and you're still going to have to pay for health costs. You're going to pay for Medicare once you're over 65. If you're not 65, you're going to have to fund that gap. Different ways to do that depending on your employer plan. So some of those expenses are going to still be there, but when you're generating retirement income from your lifetime savings, you're not going to be saving money in a 401k plan. So people look at, it happens all the time. It happened just this week. I had somebody come in and they figured if they needed $85,000, $90,000 of net take-home pay, they would need $120,000 to $125,000 of gross pay. Meaning on $120,000, $125,000, they'd have $30,000, $35,000 of income taxes. And that's just not the case. So, and once people are retired, they see the impact of that. But I think the biggest thing is people that are retired hopefully have created some planning. They've incorporated Social Security election into their plan. They've had to sit down and figure out, how do I take my life savings and generate dependable income? Now, there are some other factors, though, involved here. I think one is the inflation that we've been seeing. We see the impact of what's happened over the last couple of years. And, we had the big announcement earlier this month that inflation through August, 12-month inflation is down to 2.5%. And it was a drop from 3% from the prior month, a much deeper drop than the Fed was expecting, which, of course, led to rate cuts. But bottom line is we still feel that prices aren't coming down. They're just going up slower. And so we feel that so much in our everyday expenses. And I think that creates a distorted picture a little bit. Well, it's not distorted. It creates a reality is a better way to say that. Sorry, I shouldn't have said distorted. It creates a reality that we all live with, that we know it's tougher to make ends meet. Now, I do think the state of our national affairs has a big impact on this too. Because consumer confidence in the economy, in spending, is a huge factor. And if we look at our national affairs, there are three big things that we see here. One is the federal debt. Everybody is worried about our climbing debt. I mean, $34 trillion. It's just an astronomical number. More importantly, if we compare that number to the size of our economy, it's higher than it's ever been. And that's how we can compare a national debt number in 2024 to a debt number in 1955 or 1973? How much do we owe relative to the size of our economy? I mean, our economy is a lot bigger now than it was then. So we would be expected to have more debt as a dollar figure. But our debt as a percentage of GDP, gross domestic product, is higher than it's ever been. And we see the tremendous deficit spending. And let's be honest here. The huge runaway deficit spending has happened consistently for a pretty good while on both sides of the aisle. Then we've got the politics of a presidential election. And regardless of where you stand, everybody is super, super concerned about the election. And so what happens is there become concerns about our economic future, about what's the dollar going to do, what's the stability of the U.S. government and U.S. treasuries and the money that we have and the money that we spend. So I think that it creates this world where people that are not retired yet become super, super concerned that they're going to need a lot more in retirement to be successful. And you may need more in retirement. Okay? My takeaway from all of this would be you need a comprehensive, not only financial plan, but a comprehensive retirement income plan. You know, one of the things that was interesting in this study from Edelman is that more Americans are turning to financial planning and professionals for guidance, financial planners. 74% of those working with a professional reported less stress about money issues. 74%. And I think that's understanding, what do you need to be budgeting for income tax in retirement? How do you need to be deciding on critical things like Social Security election? How do you need to be structuring income that doesn't depend on the short-term whims of the stock market? But how do you grow that income over time to fight inflation? All of these things are so critically important. And so I think being educated, if it's appropriate, working with a professional. Now, of course, that's what we do at Brogan Financial. I do think it's important to work with a professional that is fee-based and is a fiduciary. In other words, they're regulated to act in your best interest alone, which is what a fiduciary has to do. Not all advisors are fiduciaries. And we're going to get to our first break, and when we come back, I do want to dive a little bit into how do you know when the information you're getting, everybody's pointing fingers at each other. How do you know when the information you're getting is good, and who do you trust? We'll expand a little bit into this word fiduciary. How do you really know when you meet someone? I mean, Bernie Madoff was regulated as a fiduciary, and yet he committed massive amounts of fraud, right? He stole massive amounts of money. So somebody saying that they're a fiduciary, I mean, that's the way they're regulated by the government. Are they truly acting as a fiduciary? Now, they should be. But what does that really mean? So when we come back, we're going to dive a little bit more into who do you trust? There's so much competing information out there. How can you meet with somebody and get more confidence over what you're doing and trust you're getting real answers and not being sold things? So stay with us. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for listening to More Living this morning right here on News Talk 98.7 WOKI. I'm Jim Brogan, and how do you know who you can trust and what information you can trust? Now, we could talk about this in a lot of different areas. Certainly in this politically charged environment, you know, we've got people pointing fingers. When it comes to financial advice, you go online, you read articles, and they contradict each other. I mean, you hear one expert say, only invest in passive indexed funds. And then you'll hear someone else say, only invest in managed mutual funds. Or you'll say one, only invest in individual stocks and individual bonds. You'll hear one that says retirement income annuities are the best thing since sliced bread, and others that say they're the worst things in the world, don't even consider it. So how do you really know who to trust? You know, I just spent that last segment talking about this study from Edelman Financial Engines that it's, you know, of all the people surveyed, you know, would you rather have $1 million in extra retirement savings, or would you rather have 5 more healthy years? And it was a coin flip. Just as many answered, 51% actually answered they'd rather have the extra $1 million in retirement savings than 5 more healthy years. And that's kind of alarming to me. Yet at the end of that study, it found that 74% of those working with a professional report less stress about money issues. But how can you believe? What do you believe? And who can you trust? So let's talk about this word fiduciary. It's become very, very in vogue to talk about fiduciary responsibility. Over the last 20 years, the entire financial industry has moved into a world where more and more are becoming fiduciaries. And the government is actually trying to regulate that on advisors. The government is more and more trying to get involved and say a financial advisor should be a fiduciary, which again means that they have to act in the best interest of the client. You'd think all financial advisors would be fiduciaries, but that's not been the case. So that's the regulation, and the Department of Labor recently passed a rule that actually said if an advisor gives advice on a retirement account, an IRA, a 401k, any kind of retirement account, they now must act in the client's best interest. They are now a fiduciary. But you know, most advisors now have at least some element of fiduciary responsibility. You know, as a fee-based advisor, you know, when we went at Brogan Financial, you know, I started Brogan Financial in 2001. Hard to believe it's been 23 years. And in 2005, I went fee-based. I dropped my broker-dealer. I no longer am even licensed to get a commission on the sale of a security, on a transaction, a stock, a bond, a mutual fund, whatever, a variable annuity, whatever. If it's a security, I'm not licensed to get a commission. And a fee-based advisor is regulated as a fiduciary. But over time, the worlds in the financial realm where you have commission-based advisors and you have fee-based advisors has really merged, where regardless of how somebody's licensed, 80 to 90% of what most advisors do is fee-based, where they charge a percentage, or they charge hourly, or they charge an annual planning fee, or whatever. And when they're charging based on a fee and not commissions, typically they're going to have to act as a fiduciary. So, you know, the worlds are becoming blended, and a lot of advisors are licensed both commissions for securities and are fee-based, and creates an interesting dichotomy there. And an interesting conflict in my view. That doesn't mean there's never a reason to do that. I've just chosen to not have those conflicts of interest. But I know good advisors that are both. But they are regulated as fiduciaries. And again, anybody gives advice on a retirement account now, they are now regulated as a fiduciary. But you know, you still hear horror stories all over the place of advisors that steal money, do the wrong thing, offer securities without a license, just all kinds of different, and get a commission, just all kinds of different things. And as I mentioned it before going to that last break, Bernie Madoff, he was a regulated fiduciary, and yet he stole mountains and mountains of people's life savings. How do you truly know what you can believe when you see the news or you read articles online, and then How do you know if you're meeting with a fiduciary who's truly acting as it, not just regulated as a fiduciary, but acting as a fiduciary? So first, let's talk about news sources, online, emails you get, articles, things like that. The first thing I always ask myself is there an agenda here? So whomever is doing the article, or whoever wrote the article, or if it's a news person, is there an agenda? And a lot of times there is. And, obviously, probably one of the most obvious things I can think about is all the commercials about buying gold right now. People are selling, they're wanting to sell gold. Gold's at all-time highs. But then I hear other things. You see one article and people are talking about economic gloom and doom. You see another article, people are talking about, hey, there's light at the end of the tunnel. The economy's doing much, much better. One of the things I'm going to talk about here a little bit later is what we call the vibe session, that there's a disconnect between what consumers believe the economy is doing and what it's doing. So what do you believe? Is there a political slant? If you read an article online, is there a political slant? And if so, try to see it through that lens. It's so important. And you know what? We have our own biases, right? We have our own political lenses that we look through things with. So it's important to try to be neutral when we look at things about the economy and about our money. That doesn't mean politics doesn't affect our money, but we want to try to be somewhat agnostic in terms of studying it and researching what the impact could be in the future with politics. Now, if you're actually meeting with someone in the office or virtually, because since more and more people are doing that now via Zoom or even on the phone, how do you know if that person is truly protecting your best interest and acting in your best interest? And the thing I've always said, and if you've listened to this show over the years, you've heard me say this, what does the meeting look like? How are they interviewing you? Are they getting to know you and determining your needs and showing you where you are and where you can go without a focus on products? Or do they seem to be steering you a certain direction? And that's really what you should be looking at. I mean, by the time we make a firm recommendation of exactly what the client needs from an investment and income and financial plan perspective, we've typically met with someone for close to 4 hours, 3.5 to 4 hours over a period of probably 3 meetings, 3.5 hours, let's say. So in other words, we're spending a lot of time getting to know the client and getting to know their needs and desires, and then evaluating what they're doing and showing them with transparency what they're doing. And then showing them, hey, where are some areas where there are risks, and giving true independent advice. So when you're meeting with someone or you're not sure who to trust or what to listen to, always ask, is there an agenda here? Are they selling something? If you get an email talking about gloom and doom, the stock market's going to crash 50% in the next 90 days. Well, read on through that. Is there something being sold, or what's the agenda of the writer? Usually they're selling some sort of research, something like that. Likewise, when you meet with an advisor, what are they focused on? Meeting your needs, asking questions, helping uncover truth in what you're currently doing and what you can improve on? Or is there a slant there? Are they selling something? Are they trying to scare you? What is the slant? So I think it's important to just try to view things through a lens as independently as possible. And then when you're meeting with people, professionals about finance, how are they handling the process? Especially when you're engaging with them for the first time. Because the reality is, back to this article I referenced in the first segment, a poll of people, would you rather have a $1 million extra dollars in retirement savings or have 5 more healthy years? And it was a coin flip. 51% said they'd rather have the $1 million in savings. 49% said they'd rather have a healthy 5 years. And that's alarming to me. I would think more people would want the extra healthy 5 years. Now, I think it's certainly, our different backgrounds, our different current situations, our economic realities all impact that, which I talked about in the first segment. But the bottom line is, this study turned over that more Americans are turning to financial planners for guidance and getting professional advice and management. And that doesn't mean just how do you invest your money. That means how do you structure your money to serve your needs? How do you generate income? How do you save on your taxes? How do you plan for estate planning? Who's going to take care of your stuff if you cannot? Do you have good powers of attorney in place? What about healthcare catastrophe? Do you have a plan for all of that? There are just so many things that should be discussed when you work with a true financial professional rather than just how should you invest your money? Should you buy this or buy that? That's product focused. Tell you what, we're going to get to our next break, and we've seen that there has been a rate cut, right? The Fed 2 weeks ago cut rates by 50 basis points, 0.5%. How do interest rates adjustments, how do those affect retirement spending when you're in a spending phase? How's that likely to affect you, and what do you need to be aware of in a world of decreasing interest rates? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back. This is More Living with Jim Brogan, where it's all about living the best years of your life your way. Check us out online, broganfinancial.com. We podcast all our shows on there if you click on radio. And we have lots of resources. If you go to resources, you can print out all kinds of different resources. In terms of upcoming classes, my next class is at Pellissippi State, Hardin Valley, How to Thrive Financially in Retirement. It is two 2-hour sessions on Tuesdays, October 15th and 22nd. So that's coming up 2 weeks from this Tuesday, a little over 2 weeks away. We do have limited space, so I'd love to see you in 2-hour sessions. I'm going to talk about the 7 key areas that you need to address, everybody needs to address, potentially, to be able to have a successful retirement. Many of the things I'm talking about today. You can go to PellissippiRetirementPlanning.com. And you can find more information. You can download a syllabus and register. You can also go to my website. If you go to BroganFinancial.com, go to resources and then classes you can pull up. I've also got a class coming up in November, a one-night class on tax planning and your retirement. Now, interest rates are coming down. The Fed did a 0.5-point rate cut a couple weeks ago, and they're signaling there's more on the way. What should we make of this? They lowered the benchmark rate by 0.5%, and that was larger than they anticipated, 0.25%. The decision reflects a significant shift, I think, in the Fed's approach to managing potential economic risks. The cut was made to prevent further weakening in job growth and to stimulate economic activity. And it signals that the Fed is prepared to go to greater lengths to support the economy. Now, that's the first rate cut of this size, since March of 2020, when, of course, we were in the pandemic. Now, the job market remains relatively stable, but this is always important to remember because the Federal Reserve has this dual mandate, right? They're to control, stabilize prices, which would be inflation, and to have full employment. Well, unemployment over the past 8 or 9 months has risen. At one point, it was down to 3.4%. It's now up to 4.2%. Typically, when we have an increase of more than 0.5% and we go over 4%, there's a decent risk of recession. So while the job market has softened in recent months, job gains are slowing. Hiring has been stalling in white-collar sectors. And the Fed acknowledged the trend. They maintained that the overall labor conditions are robust. But he pointed out that while the increase in unemployment over the last few months is a sign that the market could cool further, which would raise concerns about long-term job stability. So, I think with the inflation rate surprisingly coming down to 2.5% as of the end of August, I think that gave the Fed cover to do a more expansive rate cut and doing 0.5% instead of 0.25%. It does kind of signal to me that the Fed is a little bit concerned, about underlying economic weakness that could pose risks. Now then, of course, there's political implications. J.D. Vance has been criticizing Kamala Harris for driving up mortgage rates. Kamala Harris has welcomed the Fed's decision to lower interest rates. Former President Donald Trump has suggested that presidents should have influence over rate decisions. So there's just a lot going on out there here. And in terms of moving forward, the Fed has indicated plans for additional rate cuts in both of its next meetings in November and December, with markets pricing in further reduction. So, bottom line, it's hard to read through all this and this data, and it can make your head spin. Here's bottom line. The Fed raised rates to manage price stability, and unemployment remained very, very low. And unemployment has finally started to increase. We started to see cracks. And so inflation surprisingly went to 2.5%. So the Fed decided it was safe to lower rates 0.5%, with more to come. When we are in a period of decreasing interest rates, how does it affect you when you're in a spending phase of your life, when you're retired? The current rate environment has created opportunity in the investment industry. Now, we have to remember, the rates are higher because inflation is higher. But it has created opportunities. We still can get, even with 1-year CDs now dropping down under 4%, and they're around 3.8, 3.9% for a 1-year CD. That's still higher than the 1-year inflation rate at 2.5%, and that's an anomaly. And so there become opportunities on the safe money side when we talk about guaranteed interest. There become more opportunities in environments like this that we can take advantage of. As rates come down and inflation comes down, we're going to see less of those opportunities more than likely. So we want to take advantage of these opportunities. The other thing is, when rates come down, it's signaling there may be concerns of an economic slowdown. However, the market likes that interest rates are coming down. So what does it mean for the stock market? The answer is, we just don't know. And I know that's surprising to hear, but, we don't know the short-term implications of the stock market. Without fail, just about everybody that I meet, either in my office or in the community now, when we talk about the current economy, just about everybody is concerned about where we're headed. And I think, that creates concerns about, should I be fully invested? I can get CDs at a pretty decent rate. What should I do? Interestingly enough, this is up until 2 weeks ago when the Fed cut rates at 0.5 point, there have been 20 other times since 1980 that the Fed has cut rates by 0.5% or more when we were within 2% of an all-time stock market high. And subsequently, the market has rallied to hit new all-time highs. In all 20 of the previous instances since 1980, over the last 40-some years, markets 12 months from now, from the rate cut, have been up. Now, that doesn't mean they will be up, but this could be the first time they're not. And in some of those markets, they were down after 3 or 6 months. But overwhelmingly, they rallied, and then in a year they were up, all of them. So, I could sit here, I could make a case that the market's going to continue to boom. I could make a case that the market is going to bust. The reality is, we don't know in the short term what's going to happen in the market. We do know that a well-diversified and balanced portfolio where you can control fees and costs and you can reduce taxation can be successful in the long term. You can reduce risk with better diversification and also understanding how to structure income without depending on the stock market. So you can do all those things. And historically, over time, the market has been the best way to beat inflation. And retiring today, you've got to plan on potentially a 25 to 30 year lifetime of needing to generate income for a long time. And yeah, your spending will slow down as you age. Your discretionary spending will, but your medical expenses in the later years of retirement will make your spending actually go up towards the end of your life. So you have to have a mechanism for fighting inflation. I would say in the long term, inflation is just as big of an enemy as losing a lot of money in the market. They're both equally big risks when you go into retirement spending. You've got to be able to manage both of those things, and worrying about the short-term implications of the stock market, I think, is a fool's errand. So now, rates coming down should be good for the economy. Will it stave off a recession? I don't know, but they are trying to improve the economy. So it's saying, some inflation is healthy. And when interest rates are a little bit higher for a retiree who's not spending as much and is depending on their life savings to generate income, a little bit of inflation and higher rates can be a very good thing. So it's just a matter of keeping a perspective on all this and understanding how to take advantage of opportunities when they present themselves, how to protect yourself from unnecessary risks, how to structure income that doesn't depend in the short term on the stock market, but how to have growth long term to fight inflation. We're going to get to our last break. When we come back, charitable giving has taken priority for 80% of pre-retirees and retirees want to be charitably inclined, both with their money and with their time and their volunteer resources. How can we be smart about how we give charitably and use the tools that the IRS has given us to make more impact, both for the charity or the church and for ourselves? Stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I want to thank you for tuning in. I'm Jim Brogan. Check us out online, broganfinancial.com. Also, my next class through Pellissippi State Community College at Hardin Valley is on October 15th and 22nd. It is a 2-night class, Thrive Financially in Retirement. You can go to PellissippiRetirementPlanning.com to download a syllabus and to register. That's coming up 2 weeks from Tuesday, October 15th and 22nd. A new study by Fidelity Charitable really casts refreshing light, from my perspective, on the significance of philanthropy in retirement planning as a strong majority of Americans sounded out their passion for advocacy. In this study, which surveyed over 2,500 individuals, 78% of those aged 50 to 80, both pre-retirees and retirees, prioritized charitable giving, almost 80%, 4 out of 5. Retirement, I think, according to this, a quote from the Fidelity Charitable's head of donor engagement said, retirement is an exciting new chapter in life that creates opportunities for retirees to spend more time and resources to support many of the meaningful causes that they care so much about. And I think that the study really reveals a strong connection between retirement and increased interest in charitable activities. Nearly half of the participants highlighted that they are actively volunteering as well. So this study comes at a time, this year alone, in 2024, it's estimated that 4 million baby boomers are expected to retire. And that could significantly impact charitable donations and volunteer efforts. Now, despite the strong inclination towards charitable giving, there just seems to be a lack of discussion and knowledge about donation strategies, how to make the greatest impact. And I think we've got to look at a few things. First, we have to look at who are we giving to and how good are they with their money? How frugal are they? How streamlined are they? For every dollar you give, how much goes to actually benefit the people or the things you're trying to benefit? A great resource for that is Charity Navigator, charitynavigator.org. It's a great resource that they score charities as best they can. Some of them are harder to score than others depending on how they file their public documents. But bottom line, they give you great data about companies, and they give a score, and they judge companies in different areas: transparency, fiscal responsibility, ability to continue to operate moving forward, and being, solvent, several things. So number one, you need to understand who you're giving to and where's that money going. Is it truly benefiting who you want it to benefit? But then the other deals with many of the tax benefits that are available to us. If you make a cash gift to charity or church, when you write a check, if you're not itemizing your deductions on your tax return, if you're taking the standard deduction, when you make a cash gift, write a check, you're getting zero tax benefit from giving that money. Now, don't get me wrong. I'm not saying give money so you can save taxes. You should give money because you want to make an impact. But if we're going to do it, let's make maximum impact. We can either give more if we're smart about it, or we can give the same and we keep more. Who wouldn't want to do that? So cash gifts lose some of their appeal, especially when people get into retirement, because you don't have as many deductions, and many retirees are not itemizing. So, number one, think about, are you being able to get the power of a deduction? But then the other thing is, when you give an asset, if I write a check for $100 to church or charity, that money at the bank is worth $100 to me. Now, if I have a stock that I bought for $50 and now it's worth $100, it's not worth $100 to me because I have to sell the stock and pay either a short-term or long-term capital gain. Likewise, if I sell a mutual fund or any kind of an appreciated asset, I have tax to pay. If I give shares of a stock or a fund directly to the charity, not only do I still potentially get the deduction on the gift, I also do not have to pay tax on the gain. Any time that I can give something to church or charity and not have to pay the tax on it, on my end, plus get the deduction for the gift, that is a win-win. Likewise, if you're over 70 and a half, you have the unique opportunity to give money directly to church or charity from your IRA without paying income tax on that distribution, and that's money you've never paid income tax on. So $100 in an IRA is not worth $100 to you, but it is to the charity. So why not give the 100 from the IRA and you keep the 100 at the bank since it's all worth it to you? That 100 at the bank's already been taxed. Charitable giving is such a powerful thing, and I think should be a part of your financial plan. Incorporating it into your financial planning and how to give and make maximum impact is crucially important. Thank you for tuning in this week. We've discussed finances because greater wealth provides for more living so you can live the best years of your life your way. This is News Talk 98.7 WOKI. Have a very blessed weekend.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.